and deal with, worst case scenario. We all want to be optimistic and hope for the best, but we have to prepare for the worst. And I think the mindset that rates will come back down, as they were in the COVID era,
No.
I think they have to understand that it took a global shutdown to get rates that low. I think right now, more than ever, they need to understand their worst case scenarios. They need to understand the reality of where they're at and make a decision, okay? Because if they're hoping for a best case scenario and not preparing for the worst, they can be caught under this rate, market go the other way. And, with all the buildings, $1 trillion buildings that are non-performing, what's going to happen to cap rates? What's going to happen to prices? So that's something they haven't dealt with realistically in how many years?
Hi, it's Kris German, and welcome back to the Apartment Dealer Show. Today, we're going to discuss all things commercial financing. If you're a multifamily landlord, you want to lock in for this conversation because, of course, there's been much talk of late. What will the Fed do with interest rates, and how does that impact investors like you? With me today is Mr. Gil Figueroa. Gil has been a commercial loan broker for decades now, funding millions and millions of dollars worth of loans, especially here in Southern California, and has worked with multifamily investors of all sizes, from those we would call mom and pop on the small side, kind of like my wife and I, to very large institutional type of investors and everyone in between. And Gil has agreed to spend some time with us today to discuss the current state of affairs and the underwriting of loans, the qualification of loans. What are lenders sensitive to today, given everything that's going on politically and economically? And again, we're just grateful to have Gil with us. So Gil,
Thank you.
Let's start here. How would you characterize the recent trend on the movement of interest rates, say the last 90 days? Because of course, it seems like things have just been bouncing around for the last couple of years. But the last 90 days, if you just had to characterize it, how would you do that?
Well, at our last seminar, I discussed that we probably have a ABC market as far as rates going up and then potentially down. Just recently, we broke a threshold that we haven't broken since December of last 22, which was 3.68, and we just broke it recently, but just barely. And I think it's somewhat of a tough resistance area. So we'll see how the Fed moves, and more importantly, their forward language. Because as we know, this is a futures market, and price is already priced in as far as that Fed move is coming in.
Yeah, and of course, you're speaking to the 10-year Treasury, the yield on the 10-year Treasury, because commercial loans, by and large, are tied specifically to the 10-year Treasury. So even though,
for the most part,
Powell may say, well, we're going to lower a quarter point, which many assume that he's going to do. Some argue it's a political move, or, who knows. But that quarter point doesn't directly correlate to, that means commercial interest rates are then going to go down by a quarter point.
No, it's a short-term rate. So it's short-term. So you'll see credit cards move down, prime rates, and equity lines and so forth. But anything that's tied to a longer term, as the 10-year Treasury, slightly moves. What moves the 10-year more in this situation, where this could be a one-off move, would be the language of future cuts, and where he sees, this landing, so to speak. So that's really what's going to affect us. And obviously that's coming up just a week from now.
Mm-hmm. Interesting. All right. How has inflation and the overall economic environment influenced loan availability? So of course the lenders are keen on, what's going out on the street. How has that affected things as you're underwriting loans for investors?
As I mentioned previously, it's become much more, I wouldn't say forensic, but lenders are not wanting to make any mistakes. They're asking a lot of questions of the rental history, of the performance of the asset, and then they're wanting to see the ability for the borrower to handle the situation as rates going up. So some of them have included a hurdle rate in underwriting.
So explain a hurdle rate to the viewer.
So let's say, for instance, overall apartment loans over $1 million right now are probably just under 6%, in the 5.75% range. So some lenders, let's say Chase, for instance, uses a hurdle rate. So instead of underwriting their debt service at a 120 at the actual rate, they will use 1% higher. So they're using 1% higher in qualifying the transaction.
And that really takes a chunk out of the loan dollars, I imagine, right?
Well, it changes our DCR really from 120 to 130. But it's a very effective marketing move where they're not telling us they're effectively changing their DCR. And so what they're doing is just, applying this hurdle rate to give themselves a little more room. Because obviously, a lot of people are underwater right now as far as debt service is concerned. There's going to be loans that are coming into attrition as far as maturity dates that are going to have a problem. So these folks are going to have to either maybe put some cash in the deal to be debt service.
I'm going through that myself right now, is that we bought a building during COVID, got a great deal on the building, revamped it, rents are at market. So we thought, hey, if and when the day, we took a 3-year loan, and if and when the day would come for us to refinance, we should be in great shape because we would have market rents in place. And thank God we had market rents in place, because even at that, our new loan is $100,000 less than our previous loan. So we're having to inject $100,000 of cash on top. So we're showing up to the closing table with another $100,000
for refinance.
Just for refinance. And so I can't imagine for those folks who say refinance when things were in, 3%, they didn't move the rents for whatever reason, just think, I'll take advantage of the rate. And here they are now trying to refinance, a few years later.
Right.
And that's what you're speaking to, right? Is that the underwriting of that?
Absolutely. And a lot of these folks couldn't increase rents because of COVID restrictions, or they had, tenant fallout.
Or the city or local ordinance.
Yeah. So there was so many multiples of issues that were hit. It was kind of, frankly, a perfect storm because they did get an amazing rate, but now, obviously, now the rates have just about doubled, and the metrics don't underwrite as far as cash flow.
Well, it's interesting that you would say Chase has this hurdle rate because Jamie Dimon, the leader of Chase there, he's been one of the strictest critics of the Fed lowering interest rates too soon. He always would come out and say, I don't think it's the right time. We're still on the verge of recession. And even here recently kind of said the same thing. So surprised that his banking institution would be on the conservative side of underwriting, especially when he feels whatever the data he's looking at still tells him we're not out of the woods quite yet.
Yeah, there's a few times I agree, but I would have to agree. Yeah, I would have to agree. There's a lot of non-performing product coming up.
Yeah, I think by the end of 2025, it's $1.5 trillion that's going to come due of commercial loans. And what's projected, and a lot of things could change, but what's projected is 25% of that is going to be unfinanceable, or they're not going to be able to obtain the original loan amount or the amount they need to refi
without equity infusion.
And so who will have it? Right. We touched on rent control. So now, so 2019, we've had rent control across the entire state. Since then, individual cities have stepped up and said, we're going to put extra protections here. We're going to have extra protections there. What, if any, bearing has this had on the lenders as they're underwriting loans and so forth?
Oh, a tremendous change. So previously, we had value-added lenders that were able to underwrite at a different DCR based on market rents. So they had the ability to maybe go to a 110 debt ratio if the deal had real upside, okay? And if the principal, the sponsor had the ability to increase rents. In other words, a track record, right? So if the sponsor had a track record to increase rents, then a lender with a strong borrower could say, hey, you know what? You can get it there in a year, and we're going to lend you as if you got it there in a year.
The market rent. So regardless of what the current rents are,
Yeah.
because you've shared this business plan with us, based upon the forecasted rents, we're going to lend you total loan dollars based upon that future
That's
forecast.
right. For the right, obviously, season.
And you funded a few of our clients with
Many.
Yeah.
So that's gone. That's completely off. We've lost that completely. And like I said, lenders are definitely looking not to make any mistakes. And you can see that Some lenders aren't even taking new first-time buyers. So even Chase is one of them that is really,
you got to have a strong resume.
You got to have a resume. You got to have some history. They're not letting newbies into this market, so to speak. Now, that's a case-by-case scenario. Someone with a lot of capital, someone with management.
If they're well capitalized, it's different.
Right. So it's different, but a case-by-case scenario. But overall, lenders are much more conservative, much more.
Well, and I don't think this is a market for a newbie, to be honest, right? So yes, cap rates are more attractive, but we're in some choppy waters right now with, we potentially might have vacancy control that might pass in November. And even just, again, with each city and these local ordinances, even many of the landlords within the city who currently own don't understand the ordinance of their local city, let alone a new guy who's coming into the market.
Right.
I had a conversation with Mike Brennan, the eviction attorney who speaks alongside us at the educational event. And he and I basically landed on a word, intentional. In other words, landlords have to be much more thoughtful, intentional with respect to what is it that I'm going to do with this specific property versus years ago, you could have bought just about anything, managed it half-ass, Mickey Mouse, and you still would have done fabulous. You would have come out smelling like a rose, looked like a genius. It doesn't look like it's that way anymore.
No, and for years at your speaking events, I've been pounding the wall saying if you don't have the right business plan, the right objective, you're going to fail. So I've been very clear with that. And I think, the optimism of the last 20 years has kind of gotten to the point where now people are being realist. And I think that's very needed right now in this time. So people really need to look at their situation, have a professional, one of us review it and see what their objectives are, how long they're going to own this, can they do any value add, what are they going to do here? But they have to have a plan because obviously the nemesis of rate increases potentially in the future, even more rental issues is something they have to contend with.
Well, you'd be surprised how many landlords I still speak to that don't understand the full extent, even of statewide rent control, but more often than not, even the local ordinance in their city. And they'll argue to the point, oh, well, that's not going to last forever. Oh, no, they're going to change that. And it's like, no, this is this is the law of the land. And especially a lot of those who have been investing for some time, they don't want to acknowledge that what it really means is my property value has been impacted. They just don't want to acknowledge that because it's not the normal things that would impact the property value, such as the cycle of the market, or because their rents went up or down, or because the building is in disarray or needs improvement. No, it's because some local politician, board member decided we're going to have rent control, and overnight all the investors said, okay, well now if I'm going to invest in that city, I want a greater rate of return, hence your property value went down.
Right.
And so, that's just and on top of it, they're taking in the buyers are taking into account the new lending world that we're in. All right. How are lenders approaching LTV and debt coverage ratios given market volatility? So I know you mentioned the hurdle rate.
Right.
Is there anything above and beyond the hurdle rate that addresses the volatility, them kind of protecting their position?
Absolutely. So what we've noticed lately is lenders are adding caveats to how long the tenants have been there. And they're being very...
Really?
Yeah. So it's in the guidelines now.
That they want this tenant season.
Right. So that's been recent, very recent, within the last 60 to 90 days. We're seeing a lot of that they're saying, hey, you have a building that's not seasoned at all. You need at least 50% at 6 months, or you need 20% in a year.
Because you just leased it up because you remodeled the whole.
Right. So lenders are, unless you did that, right. So a lot of buildings have new leases turnover. So if there's an excuse for it, as far as value add component, then obviously that works. But if there's no excuse, in other words, this is just a building that's turning, or new management, or new management guidelines, whatever the case may be, they're getting to be more conservative. Most definitely. And I haven't seen that in 30 years. So this is a whole new world we're tracking here, so to speak.
Yeah, trying to protect their position.
Exactly.
What are the key underwriting criteria that lenders are focusing on for multifamily properties right now? So, okay, we got the the tenure of the tenants. We already discussed that maybe as a new buyer, you're not going to, some banks won't even look at you. But let's say it's your average investor. He's got a few properties under his belt. He's going to put, say, 40% down on a building if it qualifies for 40%. What can this investor expect in the underwriting process that maybe is different from, say, 5 years ago?
Well, it really depends on the asset too. So if you have a great performing asset that's got long-term leases, he's probably going to be smooth sailing, a seasoned guy. If he's got an asset that needs work or has been transient or some type of, complete, revamping, so to speak, as far as renters are concerned, there might be a lot more questions. It might be tougher. And, the remedy, so to speak, is they ask for maybe to see more reserves. Or some banks are even asking for a banking relationship. Okay, so that used to be as a perk, but no longer.
We're low on liquidity, so we want to collect funds.
Thank you. Thank you. That's a whole other conversation.
Yeah, it's another conversation.
But so my point is now before where, asking for a banking relationship would be a potential perk to the rate. So they'd give you a discount rate. Now it's condition of approval. So we're seeing that. We're seeing more of that, where banks are saying unless they're willing to put a 5 or 10% deposit of liquidity here with us, we're not interested in this product. So that's new too. So we're seeing a very much conservative approach, which makes sense with all the potential turmoil of, like you said, how many billions of dollars?
It's $1.5 trillion by the end of 2020.
Right. So every bank knows this, and every bank has a handle on what portion they have of that, right?
And their liquidity.
Wow. And their liquidity.
What's interesting is that, and the reason to my comment of why I said they're asking for the monies because they might have a liquidity problem, the banks that is if you look at who's the bank that went down from LA about over a year ago, First Republic?
First Republic.
And that was one of that was one of the requirements is you had to have a relationship with them, and they wanted, I think it was something like $50,000, $100,000 on deposit.
Sometimes more. Yeah, sometimes more. But
and they still went down was going to be my point, is that even with that requirement.
Well, here's the caveat. I mean, if you're allowing a customer to get a lower rate, then that would increase what? His leverage, right? So when there's a market restructure, you're much under the leverage curve, right? So in other words, their promotion was their demise.
Yeah.
Right? Because if they would have offered a lower rate, but maybe had a hurdle rate, that would have been smart for them, right? Because then the discrepancy of today's market changes to theirs wouldn't be as large, right? So hence the hurdle rate. But that bank did not do that. That bank allowed leverage with the rate and debt service.
And the rates caught them.
The rates caught them. I mean, they were doing things 0.5% under market if a client would give them, enough liquidity.
No, I sold plenty of buildings here locally where my clients had a relationship with them, and they would just go directly to them because no one could beat them.
No one could beat them.
Even some of the more aggressive banks, no one could beat them.
Well, and the key is nobody wanted to beat them. Maybe they knew a little bit more.
Right. We'll let them. We know what's coming.
Right.
They might have the business today, but it's not going to look good long term.
Right.
So with regards to the restructuring of that, I just mentioned I'm going through a refinance. I'm having to inject capital just to be able to qualify. What advice would you have for investors? Maybe they're sitting on a floating rate. They're trying to decide, well, yeah, rates are down, but you know what? I think they're going to go down further. Maybe I should just stay with my floating rate. What's some telltale points here they need to be?
I think it's time to put pencil to pad, so to speak, and deal with realistic numbers and deal with, worst case scenario. We all want to be optimistic and hope for the best, but we have to prepare for the worst. And I think the mindset that rates will come back down, as they were in the COVID era,
No.
I think they have to understand that it took a global shutdown to get rates that low. So could it happen again? I don't know. I don't know the future, but I know this was a once in what?
Depends what happens November 5th.
Once in 100-year difference. Yeah, November 5th have some remedies, but I've always been a chartist where I think the chart is going to determine the future, so to speak, as far as things are going, irregardless of political situations. But I think right now more than ever, they need to understand their worst case scenarios. They need to understand the reality of where they're at and make a decision. Okay. Because if they're hoping for a best case scenario and not preparing for the worst, they can be caught under this rate, market go the other way. And, with all the buildings, $1 trillion buildings that are non-performing, what's going to happen to cap rates? What's going to happen to prices? So that's something they haven't dealt with realistically in how many years?
Right.
We've had just a straight up market sort of, especially here in California, so we've had this market that's been, never ending in valuation, but things have changed. So they have to have a game plan based on a worst case scenario.
And probably put their loan through a stress test, if you will, right? I mean, if they're coming up, their loan's coming due, just to test it against the availability, what products are available today to say, okay, here's my reality of what leverage I'm able to obtain. And is that still workable for their cash flow, right?
Right. What we're doing a lot of now is we're refinancing with an interest-only component. So it's giving them, an interest rate, paying interest only is equivalent to having maybe a 1% lower rate, maybe a little more, but in that range. So that's easing the deficit of what their cash flow used to be. So it's easing it. So I recommend an interest-only product. Some lenders will do it, some won't.
Sure.
And some will do it only based on future cash flow as far as what the intent of the objective of the borrower, of the owner is. Does the owner know if people are leaving? Is he going to have the ability to increase rents? Is he adding ADUs? What positive is happening here? What's the positive side of the equation? And I think more than ever, people need to come to reality of the worst case scenario, and then they have to see if there's any remedy that they can actually do to their building to increase cash flow. So more than ever, if there's an ADU remedy, I think they should take it if they have the ability, because they're going to need that cushion. They're going to need that cushion to offset worst case scenarios. That's my point of view.
Interest only, because I was going to discuss, what are some more of the more favorable types of loans out there. So let's discuss interest only a little bit further. So some investors may hear that and say, well, gosh, who would take that type of loan? Aren't you supposed to, pay down principal and try to get these properties free and clear so that, the day comes and you're without a mortgage? But many investors are of the mindset, and you can dig into this more, Gil, why they take this approach of, no, I want interest only because number one, 100% of my payment is tax write-off, and it increases my cash flow because I'm not having to worry. I don't want to pay down principal. I'm going to let the market increase the value of the building. I'm worried about cash flow today. Any other take on why an investor might look at interest only?
Well, again, if you're interest only, and this would be the best take, in my opinion, in my humble opinion, it would be that because you're, paying $1,000, $2,000 less or whatever the number is, that you have the ability to invest that back in the building for it to become a better building and increase your rents, right? So if you don't have that cash flow, obviously, and you don't have the capacity to improve your building, then you're status quo. Whatever happens, happens. But if you have a game plan, in other words, I know that I have 5 tenants that are leaving in the next 5 years, and I'm going to have enough cash flow to raise enough capital to be able to remedy that unit and bring it, to market, so to speak, depending on rent control laws, where they land. But my point is, you got to have a positive objective in where you're going here. Interest only, I believe, is great. Do you want to pay back 5-6%? That's overall, in the overall scheme of things, that's a low rate. We've been spoiled at 3 and 4s. But the reality is, if you're paying off 5 and 6%, you're spoiled. The question is, can you improve ROI on your building if you have that capital and improve it beyond that scope, right? That's kind of a personal question. I can help, you can help, and we can analyze their building and see, what their objectives are as far as any positive influence is concerned. Getting tenants out, paying them out, adding ADUs, what can you do here? And if you're doing this, where do you have your capital infusion? Do you need an infusion? Do you need to refinance? Or can you save it based on just the interest-only component? So there's, multiple ways to have a positive outlook.
Well, and to the point of capital improvement is that, there's several cities now here locally, so in California, LA County, where there's a rent registry. You have to register your units. They want to know who lives in the unit, how long, how much are they paying rents, okay. And then others that are saying, okay, on top of the rent registry, we're going to start, say, a quad annual property inspection or a triannual inspection. They're going to come through your units. And so I will welcome an inspector to come through my buildings because we've done a lot of capital improvement to them. I think when they have come by, they're quite amazed at the quality. That's what you want. You don't want to be on their radar with all the tenant protections anymore. It's not a good place to be as a landlord, in my humble opinion. You want to improve these places so that, well, one, it drives rents. So I do it to drive rents, not because I'm trying to be buddy with the local inspector. It's geared, by my appetite for increased cash flow. But the byproduct of that then becomes better tenants and a property which will stand any litmus test they want to put it through.
And less headaches.
Less headaches. Yeah. Are there any creative loans right now that exist? Investors looking at financing, but because the interest rates are still a little bit on the high side, they're not getting the leverage that they'd like. If they just walk in, say, to a traditional commercial bank, what are some of the products out there that maybe they're not aware of?
Well, right now, there's portfolio lending that has come back into play probably in the last year, and they've become aggressive up to 10 units. So right now, like you're building on Ruddick, we were able to increase the loan to value by 14% with this product. So from a permanent loan, I believe it only qualified for $850. And on this loan, we qualified for $1,050,000. So that's $200,000 more. And to this particular buyer, the interest rate difference was worthy. Mm-hmm. So we went from 6.25% to 7.25%. So it's 1%.
But he got another $200,000 in cash flow.
Exactly. And he's able to do it on an interest-only component and at a 30-year fixed. So a lot of, the older folks, or maybe people that are conservative, don't like a 5-year fix and having to redo things in 5 years. If they want a 30-year fix, it's actually available now on a smaller loan product. Okay. We actually did one in Bakersfield for only a loan of $500,000. And there was no other lending in that area, no other lending. And this lender with this product did approve it. And based on, break-even debt service. It's a higher rate, but like you said, it fits the leverage bucket.
Yeah.
So if you want some leverage, you want the ability to get in, it's there.
Well, and this particular client you're talking about, because they were doing a 1031 exchange, given the rules of a 1031 exchange, you have to carry over all your net earnings from the sale into the new property, but you also have to cover your previous sales price. And that's where they were looking to leverage, right? And so this loan product helped them, be able to, check all the boxes and get them into the size of product, size of building, number of units they had wanted to make the 1031 exchange make sense. So,
absolutely.
Yeah. Absolutely. In that sense, the 1% increase made all the sense in the world.
Absolutely.
Where do you see cap rates headed, and how do you see that affecting the underwriting of multifamily loans?
Well, I mean, cap rate is more of a, of an appraisal standpoint. Lowering rates improves cash flow. Okay. If cash flow is better, then people are willing to pay, a lower cap rate. But cap rate per se is just, NOI divided by price. Mm-hmm. So it's not really a component of the loan per se. Appraisers use that, and they have a mindset of what the cap rate should be in certain areas. But the appraisers' cap rates are so much different than what the marketing faces is. It's a completely different world. So frankly, I think cap rates overall, I don't see them improving much. Yeah, I think there's enough gray zones in the marketplace, like that $1 trillion debt, where the savvy investor is probably not going to want to pay more. Mm-hmm. I don't see it. The only thing that would drive cap rates to change that is a tremendous drop in rates. And then you have cash flow. And then if you have an tremendous increase in cash flow, then obviously cap rates will change. But especially here in California, we don't really have the ability to increase rents anymore at bay. It takes a real objective, a real game plan to do so. I think cap rates are restrained, going to be restrained here.
Yeah, and I'm of the same mindset that I think investors who have lived through this last cycle have come to the understanding that, and they knew prior, but it just put it more in concrete for them that, maybe I shouldn't have been buying buildings at a 4% cap rate and got caught up in that frenzy, because anything can happen with interest rates, and it did. And now I'm having issues refinancing. And after all, the cash flow wasn't that great. And now there's increased regulations, potential vacancy control, where now my destiny is etched in stone, what I can do with my rental rates, even if somebody moves out. So you know what? I need a higher yield, or why would I put myself through this? And I think if I had to, make an estimate here, I think that's where we're going to be for a while, for the next few years, is that, this here local, things are, say, a 5% cap rate or above. I think that's going to become commonplace. It's going to become the expectation, and the right expectation, I think, just because, again, for all that goes into managing multifamily properties, to have a rate of return that's next to nothing, or to have to put 60% down on a building in order to qualify for a loan. It was great while it lasted, but I think looking back, did that really make sense?
So you have to have a real good game plan. You just do. Like you said, the years of buying real estate hold and watch it go up 40%, I think are done. I think are done.
Investors have the need to procure commercial financing, and they may not, be all local and able to turn to you. How do they determine one loan broker from another, who to work with as they're trying to sift through the different commercial banks?
That's a good question. I mean, nationwide, we can fund nationwide over $1 million nationwide. Locally, obviously, we can do much less. What makes us, I think, valuable is the ability to change and the ability to offset and look at different abilities. So when I look at a portfolio, I look at the whole picture. There could be a business here where we can refinance the business and change the financial picture. And since we know SBA, we know the business products, we can have, a footing there. Or we can look at retail, or we can look at strip centers, or even single family, or 1-4s. So having someone that has well-versed in all assets and taking and analyzing your portfolio is super powerful. Mm-hmm. I think if you have a portfolio of different diverse assets, I think it's optimal. You have to work that way. Obviously, if you don't have a portfolio, deal with the experts. If the experts, you're looking for 3 or 4 units, deal with the experts out of 3 or 4 units. Do your homework. Do your demographics. Find out the areas and the realtors and what they're saying, who they're using. Throughout the nation. Here in California, there's no question who to use, but we'll stay humble. But my point, you need to do your homework. Find out who's doing what, how good they are, and their performance, and then get an idea if they're after your best interest or not. Okay, get a couple opinions.
Mm-hmm. As an investor, because obviously utilizing a commercial broker, there's a fee, of course, with that, and no one's going to work for free. Versus, say, if they walk directly into one bank, the bank may say, "Oh yeah, there's no fee other than your appraisal and docs." But what's the power of having a commercial loan broker versus the principal trying to go bank to bank?
Well, let's talk about that. I mean, recently we have a file together that obviously could have gone to a Chase with 0 points. I think that's what you're referring to. So Chase at the time was 595. We were able to secure 575 at a point, but we were able to secure $300,000 more capital. Okay, and by that $300,000, the buyer didn't have to come out of pocket to restructure
because the bank you went to didn't have this hurdle rate, which
didn't have the hurdle rate, and frankly, underwrote expenses a lot different. Okay, so they're more global. I'm not global. The total United States, so they take more of an average, even though California could be a higher expense ratio due to our inflation, right? Maybe a little higher. But my point is a lot more conservative on expenses, or I should say aggressive on expenses, and no hurdle rate. We were able to get $300,000 and a quarter rate lower on the rate. So is that worth a point?
Oh, sure.
100%. So there is no free game in town. So Chase or whoever offers 0 points, whether it be single family, multifamily, all they're doing is increasing the yield. It's not rocket science. We all go into the same pot, whether it be agency, Fannie Mae, Freddie Mac, whatever portfolio. We're all kind of using the same money pot, so to speak. The difference is how they roll out the marketing, And a 0 point loan sounds pretty, but the question is, can you do better on leverage and a better rate? And, that better rate, by paying the point, you could recover all closing costs, especially tax deductible, within 2 years. So if you take a 10-year loan, you're going to beat that Chase program by 8 years. So you have to look at your ROI on the loan. What is it costing me, but what is it doing for me? Now, obviously, if they're both the same, there's no question what's better. Mm-hmm. But if there's a difference, You have to look at what the premise is.
Excellent, excellent. All right, Gil. Well, thank you. Thank you for your insights. Of course, you'll be with us at our next Apartment Owners Educational Luncheon, which is coming up within a few short days. You're invited if you've received either a direct mailer from me or an email. For those of you that unfortunately aren't invited, because we try to keep our events small and intimate, of course, you can still reach out to Gil. So, Gil, if they have some questions with regards to financing, what's the best way to reach you?
They can email me at gil@firstcommercialcapital.com, or they can call me at 562-754-5626 and make it easy, 562-754-LOAN. So they can reach us either way.
All right, sir.
Well, thank you, Kris.
Thank you. I hope you found today's video informative. I hope that you've taken a look at your current loan in place, what are options available to you. And I would not count on the fact that, we're going to see 3% interest rates again, 4% again. Nobody knows. Best guess would be that's probably not going to be the case. So given the information at hand, what rates are today, take a look at your investments or your potential purchase and underwrite it accordingly, just to make sure that you are prepared, as Gil had mentioned, for a worst case scenario. Obviously, then if it cash flows at a worst case scenario, then it's even much more of a gravy deal on a best case scenario. If you found today's video informative, please give the video a like, share it with other landlords that you know. They may have questions with regards to financing. This information could be very helpful to them. If you have not, as of yet, subscribed to our channel, hundreds of hours of content on our channel there just waiting for you, all educational based and many, many hours to come, not to mention highlights from our next educational event. And until next time, this is Kris German wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.